Yeah, one of the big questions that we often ask people, and it's usually the first question, is do you care about how much money you leave behind when you pass? And oftentimes the answer will be no. They're not trying to build any sort of generational wealth for anybody. And that can be one of the biggest challenges because, especially if we're not seeing these people until they're in their 40s, 50s, 60s, they might have built up this giant nest egg. They're continuing in a job that they don't love. They're kind of, just getting up, going through work, doing the motions every day. And they really want to do something different, but they feel like they can't because they feel like they have to hit this number that's been built all around the idea of they want to pass money on to the next generation when it doesn't actually match their life goals.
Welcome to the Debt to Financial Freedom podcast. I'm your host, Victor Lagos. I'm also the founder and CEO of Lagos Financial, a residential and commercial finance brokerage based in Australia, where we specialize in helping Australians to create wealth through strategic property investments. So today I've got an interesting guest. She's not from Australia and her services don't extend to Australia, but I feel like in the Western world there's a lot of similarities when it comes to financial planning, and this one in particular caught my attention because the theme is around child-free wealth, and I feel like a lot of people think that everyone's on a similar journey to have a family, grandkids, the white picket fence, and but really, when you're child-free, there's a lot of other goals and aspirations and things that are actually achievable financially. And that's why I thought I'd invite our guest. Bri Conn, she's the Chief Experience Officer at Childfree Wealth and Childfree Wealth Specialist at Childfree Wealth, a life and financial planning firm dedicated to serving child-free and permanently childless individuals. Bri co-hosts the Childfree Wealth podcast alongside Dr. Jay Zygmunt, where they explore unique financial perspectives pertinent to the child-free community. Beyond her professional endeavors, Bri is passionate about outdoors, enjoying activities such as hiking and running, and her core values include community, education, social participation, and sustainability. Welcome, Bri.
Thank you so much for having me today, Victor. I'm excited to be here.
Awesome. So look, I guess it'd be good to just get a little bit understanding about your personal journey, I guess, that led you to become a child-free wealth specialist. And then we can sort of go into a bit more detail.
Yeah, so I always tell people, this is not the path which I would have, I think, ever explored on my own or really figured out. It really was an accident that I ended up here. And I knew I wanted to become a certified financial planner. It was something I was working on. And then I met Dr. J, the founder of Childfree Wealth. We met in a Facebook group one night. There were two different posts. One said, "What do you do now?" The other one said, "What do you want to do?" I commented on both of those. He saw that and he said, "I'm a CFP. I would love to, if you have questions, I'd love to talk with you and happy to share the journey. Otherwise," I had said on the post asking what you were doing. I was in marketing and I was a social media manager. And I said, "That's what I did." And he goes, "If you don't want to talk about CFP stuff, I'd love to refer your information to others." And so that's kind of how we started connecting. And we talked a couple of times. And eventually I just asked him for a job. And his response was, "Let me think about it," as one does, because, it was just him running a solo practice. And it wasn't having like other people a part of the team. But I figured, I need to have so many hours of experience before I can get a CFP and become a CFP. And he had that CFP credential, so it would really work in my favor. There are two different ways here in the United States to get the CFP. You can do the apprenticeship, which is a 2-year time span, and then you can do it on your own. That's 3 years. And so I wanted to do it in that 2 years, that apprenticeship timeline. So asking him was like, hey, hopefully I can get this and get it in 2 years versus having to wait and do that 3 years. So it wasn't an area that I was really familiar with or kind of envisioning myself in, but it just sort of fit my life. When I talked to him, I really connected with a lot of things that he was saying and felt, that really makes sense. I wanted to be a financial professional mainly because I wanted to figure things out for myself at a more deeper, more in depth and deeper level than I had previously. And the child free part of it was just an accident, but I love it now and I cannot imagine myself doing anything else. So I'm still here and it's been just about 2 years. So I'm coming up on that timeline where I can put my official application in to become a CFP. And it's been very exciting and it's been a lot of fun.
Awesome. That's really good. Thanks for sharing your story. And for those who don't know what a CFP is, it stands for Certified Financial Planner. Is that right?
Mhm. Yes,
Yeah.
absolutely.
So prior to being a certified financial planner, is there some other position to be just a certified planner? Oh, sorry, a financial planner that's not certified, or you have to be
Yeah.
certified in order to give financial advice in the US?
So you have to have some sort of license, and I do have one of the licenses called a Series 65 Investment Advisor Representative. You don't have to become a certified financial planner. You can just choose a license and go that way instead. And some people do that, but there's more requirements. So the Series 65 that I took, it was really just read a book, study, go take a test. This one, you have
Mm,
to have a college degree. You have to go for so many years and do experience hours. And there's a little bit more weight to it as far as the requirements are concerned. And so that's why I wanted to do that. There's also more courses. You have to do a lot of coursework. And then you have to take the test as well versus just reading
mm.
through a book. I mean, it's a hefty book to take the Series 65, no doubt, but it's still read a book and then go take a test. And so it's just a little bit different. And the term financial planner is actually not a regulated term unless it's the certified financial planner. Anybody can really call themselves a financial planner, even if they're selling insurance, which does happen. Same with the word financial advisor. People call themselves financial advisors, and really the only license they have is an insurance license. So they're just selling insurance. So it's it's not a those terms, financial advisor and financial planner, are not regulated terms.
Okay. Certified really just gives the customer certainty that you have got undergone all the professional requirements and you're regulated and
Mhm.
I guess really gives them more confidence that you can help them achieve their financial goals because you've
Yep.
got the knowledge and the resources to deliver. You may not have actually had to achieve what they're trying to achieve, but you still have the
Mhm.
knowledge. And that's good to know. And I think the other thing I wanted to mention is while the majority of my listeners are in Australia, some are in the US. And the last time we spoke, you mentioned that your license allows you to operate across the US, every state
Yep.
in America. Is that right?
Yeah, we can work with anybody in the United States. We are registered with the Securities and Exchange Commission, so the SEC, which means that we can work with anybody. Since we work virtually, we do work with people in any state, and that's totally okay. So if people have questions or want to work with us, and they are, as long as you are a U.S. resident or permanent resident, and you're living in the United States, we can work together.
Awesome. Yeah, I don't know what's happened over the years in Australia specifically around financial advice. They really have increased the requirements. So you mentioned earlier about university degree, and also the continuous professional development. But
Mhm.
it's become because of the amount of requirements to be a financial planner or a CFP in Australia, it's become more expensive to pay for advice.
Mhm.
So, as far as I'm aware, a lot of financial advisors are charging minimum between to $5,000 for a statement of advice, and then
Mhm.
there's usually an annual ongoing as well, which is sometimes $2,000 a year, and that's not accessible to most people, especially the ones that actually need the financial advice. Is it
Mhm.
similar in the US at the moment?
Yeah, it really varies um, based off of like different what the different models are. So there are models in which you can be fee based, and that's where not only do you charge for your time and stuff, but then you also make commission. And I don't promote fee based financial planning. I just don't don't think it's, gives the provides a way for people to really truly give advice. There are some people who, think that my outlook on fee based is completely out of this world, but I just really want you to pay for the financial planning and get true advice, and it's not without any impact to somebody else's paycheck. Um, there's fee only, which is what we are, which means you only pay us for our time and our services. You're not paying for if we tell you to go get an umbrella insurance policy, we're not getting commission off of that. Or we tell you to go get a long-term care policy, we're not getting commission off of that, anything like that. So there's no factors aside from you becoming a client that impacts our paychecks. And I think that it can be one of the things that can make sometimes it hard to have those lower prices. We have really tried to have multiple options for people. So we do have our one-on-one planning. And for the year of 2025, it is $10,000 a year for that one-on-one if you want somebody dedicated to you who's going to meet with you regularly. We have options where you can DIY it for the year. At least at the start of 2025, it is $100 a month to join Academy. There's DIY. You can meet with us in group sessions if you want to have like a one-on-one call, but it's not going to be regular. It's going to be with whoever's assigned that specific topic. Then there's that option as well. You pay for like an hour with us, but the $10,000 is for that's what somebody's paying to have me as their dedicated financial planner. And if they have questions, have concerns, they can just shoot me an email. So it's a lot more of, we try and do it based off of how much time does it take from our planner, how much dedication. If somebody's in the academy and they have questions, they need to come to one of the Q&A sessions, or they need to book something for us one-on-one. We can't provide advice when we don't know everything that's going on. And so the price point reflects that. It's a lower price point, but it's also lower in like not lower quality, but lower level like access, or less
Mm.
accessible to us, I guess. It's still
Yeah, I
accessible
guess
because
it's
you can
less
book a
less
session, but
tailored, basically,
yeah.
because it's all around education, right? So I'm a big,
Mhm.
obviously, this is why the podcast exists. It's around educating the listeners
Yeah.
around financial literacy, so
Hmm.
people are in a better position to make informed decisions about their financial situation and their future.
Hmm.
And I think it's good to have some type of program that's more accessible, that educates people, and then when if and when they decide to have that tailored advice, it's not generic or general questions that you have to spend hours just teaching them what terminology means, and it's really more advanced questions, and I think that's what you probably enjoy. I know I do, working with
Hmm.
investors that have gone through the journey and have got a portfolio, and we could talk about
Yeah.
different strategies and tactics and things like that. Um,
Yeah.
but I guess from the child-free perspective, what are the common challenges that a child-free couple would have, when it comes to their financial planning versus a traditional or a family-based type of household?
Yeah. One of the big questions that we often ask people, and it's usually the first question, is do you care about how much money you leave behind when you pass? And oftentimes the answer will be no. They're not trying to build any sort of generational wealth for anybody. And that can be one of the biggest challenges, because especially if we're not seeing these people until they're in their 40s, 50s, 60s, they might have built up this giant nest egg. They're continuing in a job that they don't love. They're kind of, you know, just getting up, going through work, doing the motions every day. And they really want to do something different, but they feel like they can't, because they feel like they have to hit this number that's been built all around the idea of they want to pass money on to the next generation, when that doesn't actually match their life goals. And so many times that can just be completely forgotten. And that question isn't asked. My very first experience with a financial professional, I was in my early 20s. It was the person who came to my office that I worked at the time to set up one of my retirement accounts through my work. And the first thing this guy, he walked through the door and he asked me, didn't even say hi. He just said, "Do you even know what a retirement account is?" And I was so taken aback. And not only was that a terrible first question to ask me, because I said, absolutely, I do. And I've been investing on my own. I had a Roth IRA at that point and had been investing into it for a few years and was doing a lot of things my own, and really kind of knew quite a bit. And then he just threw down this paper with all these different options and said, this is what all your coworkers do, the ones that are highlighted. but didn't ask me any questions about who I am or what I wanted. And I said, well, that's great. Let me look at all this. And so I made him sit there for I don't know how long. Well, I went through and I looked everything up. And then I was like pulling up online, seeing what things were and trying to like get more information before I picked what was best for me. And I'm glad I picked that because I think it just really lit a fire inside me to never be that type of financial advisor, to say, do you
Mm.
even know what this is? Like, that was not helpful. That was not kind. Um, but those things, he never asked about my life at any point in time. And so that is one of a huge challenge for our clients. Because if somebody doesn't ask about that and ask about what they want to do with the money at the end, they are missing the point there. Those clients could be working way longer than they need to put money away that they're never going to use or enjoy.
Yeah, that makes sense. So really, the conversations then, when you're dealing with child-free couples, let's not say individuals at this point, it's really, is it around identifying the lifestyle that they want to have between now and obviously into retirement, so that they're really funding the way they want to live and having enough money to do that? Is that kind of the main focus?
Yeah, it's funding it, and it's also making sure we're not overfunding it too. Because if they're not caring about how much is left at the end, we don't want to be working until we're 65 just because we feel like we need to work until we're 65 and then build up this
Hmm.
giant nest egg that they don't even care about to begin with. You know, many of our clients want to take a die with zero approach where we wind down their wealth over time and then they bring that number. It's like a bell curve with their number. So they're in the accumulation phase, they hit kind of that top, and they just spend down their assets over time because they don't want to leave a bunch behind at the end. Traditional financial planning very much is that just grow, 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 and keep getting that number to go up over time. But that's not their goal.
Interesting. What about philanthropic uh, goals? Is that something you sort of discuss? Because
Mhm.
obviously everyone at some level, I believe, has goodness within them and they want to give back. Do
Yeah.
you bring that up and say, look, whilst you may not have kids to transfer your wealth to, if you build it up to a certain point, it's going to create a certain level of income that's going to fund you in retirement. But then at the end, if it's still multiplying and it's still growing, you haven't liquidated your assets to zero, and those assets can actually be used for the greater good of the world. Is that something you talk about?
Yeah, we talk about that all the time. And one of the things we talk about with clients is that's great if you want to give it away at the end, but why not? Let's give it away during your life so you can see the impact that it has. Because that is so much more fun to see the impact than it would be after you're dead and you don't even see the impact that you've created on somebody. There are also, financial incentives, especially here in the United States. I'm not sure about Australia, but here in the United States, you can get tax breaks if you donate during your lifetime. So that's something we'll do with clients too is, hey, you're seeing the impact, but also you're getting these great tax breaks and it can be really helpful and even sometimes allow you to give away more than what you normally would just because you're incentivized to give it away. And it is one of my favorite things. In fact, there are some things I've been working on right now. Um, I just love giving. I think that is so fun to me is to give. And I love working on it. I love figuring out ways to give for clients, whether that be, just giving, we're giving cash every year, or they're giving away some of their appreciated stock, or maybe they're going to have higher giving goals. And so we're looking at some sort of a trust situation to give that money away. And it can be really
Yeah.
fun to go through and figure out those different options. But it is a conversation we have all the time. In fact, it's one of our key things if we're trying to get people to spend more money. Sometimes they have a really hard time spending money on themselves. And so, what we'll do is we'll encourage them to match whatever they have for their fun money every year in giving. So, let's say every year they want to do a trip that's $25,000, but they have a really hard time actually spending that money on themselves. Okay, let's plan $25,000 a year in giving then too. So you're spending $25,000 a year on fun stuff for yourself, and you're giving away $25,000 a year to somebody else who could use that money and really change their life. And whether that be, it's gifts to family members, that can be an option. Usually that's not a huge option unless it's like niece or nephew, but that's not something most people pick a ton of. But it's like giving to your favorite charity, whether that be animal rescues or a homeless shelter or domestic violence shelter, anything like that. So we do use giving, and we talk about that a lot. And that's one of my favorite topics to talk about is giving. Estate planning too, but giving is really fun.
Yeah, yeah. And do you find that people who see you are typically better at managing their finances? When I say manage, okay, let me rephrase that. They live within their means, therefore they actually have the ability to give as well as give to themselves and give to
Mhm.
others. Is that a typical type of client, or do you get people that are kind of in the I can't even handle, like, I don't even know how much I earn versus spend? You know, they've probably used buy now, pay later, credit cards, and you just got to get them into surplus, right? And not deficit, into surplus, and then start thinking about giving to yourself more and then giving to others. Is that your type of clients as well, or they're the ones that can't afford financial advice?
So our clients are really mainly the ones who can afford the higher level financial advice, at least the
Mm.
ones that we're working with one on one. We do have, the academy for people who aren't quite there yet, and that can be an option, but it's not something that we see a ton of. I will say though, it doesn't matter how much you earn. I've seen clients who earn multiple six figures a year and they still have such a hard time tracking what they're spending. And one of the tricks that we'll use with that is, okay, if you're not sure what you're spending, you really have a hard time spending, and trying to put money away after it hits your paycheck, let's just max out your retirement accounts, because that money doesn't even hit your paycheck. They're not building up credit card debt then or doing anything like that. They're just don't have that money available to spend in their checking account. So it kind of keeps them within a certain amount. Um, you know, Sometimes we'll say like you are earning more money than you necessarily. I don't. It's like out earning your stupid is that kind of the best way. Like you can make those little mistakes. Or you're like, oh man, I had this bill come out this month. I totally forgot about it. And it's a couple $1,000s. Well, we have clients who make enough to just cash flow that and not think about it. But if that keeps happening time and time again, it's when we really need to have that conversation of, okay, you say your monthly expenses are this, but every month some sort of four-figure expense seems to pop up. Is that really your monthly expense, or are we just forgetting about a lot of these things that might not hit every month, instead hit like once or twice a year? So it really for our clients is the ones who can, at least for the one-on-one clients, who can afford that one-on-one advice and just have that more of like hand holding to be like, nope, bigger picture. There are budget coaches who work with people though, who do more of like the getting out of debt and just really trying to even get into that positive cash flow situation, but that's not really where we work.
Yeah, that makes a lot of sense. So really, to your point earlier, it's not so much about how much you earn. It's really around your awareness on your spending and cash flow management. I feel like that's a common thing that people struggle with because not all expenses come out the same periodic structure. Some of them, like you said, are going to come out 6 monthly or annually, and if you don't have some way of tracking that, you may allocate funds that you shouldn't have allocated. So
Mhm.
and if you put it into say an IRA or something that you can't withdraw out again, it's risky because now you need that expense and now you have to borrow the money. Do
Yep.
you help clients to create multiple accounts or buckets and have different, you know, purpose for each of those buckets and then automate the transfers so when they get paid, they allocate a certain amount to each of them and they only give themselves a certain amount to spend and the rest of
Yep.
it they've already accounted for bills that are obviously due that month, even the stuff that's, annual and things like that?
Yeah, absolutely. So one thing I'll talk with clients is say, okay, let's kind of set up our finances. I personally do this and I love doing it with clients too because I think it makes it so easy. Is we have an account or checking account. This is where you can spend out of it. This is the money that you can spend every month. That's your checking. That's used to pay bills that month. Then you have a sinking fund account. We like to keep these somewhere we have high yield savings. So these are the things that are annual. So, maybe like you have a pet, I have a dog. My dog, whenever she goes to the vet, it's always like $1,000, it feels like. So every month you just take and you set aside enough so that way at the end of the year or like whenever they go, you have enough set aside in that account. That's your sinking fund account. And we have those different annual things. Car insurance can be something that hits annually or every 6 months.
Mm.
Every month we set aside whatever that annual number is, divide by 12. We're putting it in that sinking fund account. That way, when the time comes, you just pay it from that account, and we're not worrying about, okay, like you said, we accidentally allocated that money towards something else. It's really trying to get away from having such peaks and valleys in our spending, where we have really high spend months, really low spend months, and to even it out across the year. What can we look
Yeah.
at that maybe we just need to break out and just put throughout the year? Then I like to have a third account. It's our emergency fund account. It's another high yield savings. Not everybody does this. I highly encourage it to be at a separate bank from your primary high yield savings account, though, just because it's a nice way to keep it out of sight, out of mind, and you're never tempted to touch it if it's not the thing that you log in and see all the time. You have to go consciously look at that, because our emergency fund, you know, people can fight me on this, but I don't believe that like like oil changes, tires, anything like that, that's not an emergency. That's just part of owning a car. At some point you're going to have to do that. And so let's put that money in your sinking fund. And then our emergency fund is like, if you lose a job or if there's some sort of accident in which you have much higher expenses, and you get in a car accident, you need to replace your car, or something like that happens, and you have that money set aside. It's not those regular things that come with owning a home. You're going to have home maintenance. Let's make sure we're setting money aside for that. Owning a car, you're going to have car maintenance. Things like that. It's really having those conversations of what are potentials that are here, and it I love to work on getting people out of the mindset of getting oil changed an emergency. Getting an oil change on your car is not an emergency, and people can fight me on that to the end of time, but it's just part of owning a car. Any of those regular things, I really like working on breaking the habit with clients of, we're not using our emergency fund for that. We're gonna plan that and make sure we're setting some money aside every month so we can just cover those expenses.
Makes a lot of sense. And is there a general rule of thumb for how much you should have in the emergency account at any given time? And sometimes people say it's 3 months of salary. Some say it's 6 months of expenses, of like, all your cost. I guess it depends, right? Like replacing a car is a pretty
Mhm.
hefty uh, emergency, but really,
Yeah.
you also help with insurances, and some people would have income
Mhm.
protection as well, right? To cover the
Yep.
shortfall. How do you
Yeah.
sort of, yeah, calculate?
So, an emergency fund really should be 3 to 6 months of expenses. We don't use salary just because, we have clients who are bringing home like $15,000 to $20,000 a month after taxes. And if we told them to set aside that amount in cash when they're saving half of that every month, that would be an exorbitant amount that they don't need because they're not actually spending that. It really is that 3 to 6 months of expenses. If you're the general certified financial planner, kind of when you go throughout the coursework, they say if you're married, you have dual income household, you're working in separate areas, so you're not really like, if you have two couple who they're both tech employees, you're probably going to want 6 months of expenses. But if you have like an accountant and a tech employee or something like that, where they're in different areas, then 3 months is probably okay. If you're single or you are married, but you're a single income household, any sort of single income, we want 6 months. Self employed, we want 6 months. You're working in high risk kind of jobs where it takes a long time for you to get get some sort of job, like, or you're very specialized. My spouse is an airline pilot. You can't just pick up a new airline job and go there the next month. It does take a while to find a career. So if you have any sort of careers like that, a little bit longer of an emergency fund, 6 months is good, just because it gives you some extra time to not have to go into debt. And it's okay if you're like, yeah, rule of thumb is I really only need 3 months, but I want 6 months. That makes you feel better. That's okay. It's just when we hit anything after 6 months and we're getting up to like a year of cash, we kind of want to think about like, okay, do we really need that? Is that really realistic? Because it can be a little bit too much to have for cash on hand.
Hmm. Yeah, because then people will probably look at that cash and say, man, it's just sitting there and it's not working for me.
Hmm.
I want to invest it into something. And then they might
Yeah.
splurge, right? Or binge spend. Like, I'm going to buy a boat or something because they've got all this
Yeah.
cash. Yeah,
Ah,
yeah, I get that.
yeah.
Um, I've got a question around mortgage offset accounts. Is that something
Mhm.
that exists in the US? Have you heard of them
Mm,
before?
so I explain more because the country differences here. So
Okay.
mortgage offset.
So I did a whole episode on this. So like let's just say you've got a principal place of residence, your
Hmm.
PPR. Uh, you've got a mortgage, so let's hypothetically it's a $500,000 loan that you've
Hmm.
got. Um, if you've got an offset account linked to that $500,000 loan, it's basically just a bank account. But hypothetically, you had a $100,000 saved, rather than putting that into a high interest earning account where the earnings are taxable, you have to pay
Hmm.
tax on the interest you've earned, right? You could actually offset your home loan or your mortgage. So if you had 500,000 balance and you had 100,000 sitting in your offset bank account, you'll
Hmm.
only be charged interest on 400,000. So
Okay.
each month, you're actually still making your regular repayment on an amortization schedule of 500,000. So
Hmm.
what happens is the interest reduces, but your repayments remain the same. So more of your repayments go towards the principal, and you actually end up paying off the mortgage faster while you still have access to your own funds. And that's
Okay.
where an offset account can be more valuable. Do you guys have anything like that?
Not really. At least not anywhere that I've heard of. Maybe like down somewhere deep in like some super fancy thing, but I haven't heard of that. I've like come across anything. People will take and do margin loans or well, margin loans is probably not the best example of that. Um like asset backed loans, that's probably the closest, in which you take and put up one of your assets, whether it be land or property, and use that as an asset. Sometimes people will put stock up there and use that to kind of back the loan. But that's probably the closest. We don't encourage that, especially stock backed ones, because that stock can go down in value. So
That's right.
it's not really a cash thing here. They're not. It's hard to like say that it's a one-to-one translation across countries there.
So what about when people do have a mortgage, and they obviously are paying a rate of interest, and that interest
Mhm.
is not tax deductible because it's their principal place. It's not
Mhm.
it's not a rental. Don't you encourage them to actually pay that off as fast as possible, or use their cash to pay that off so they're not paying all this additional interest and they can free up the cash flow and free up the equity? Or do you still say put it in high income earnings and IRAs and pay it off over 25 years? What's the
Yeah.
kind of, yeah, it's curious.
Yeah, it really depends on kind of their goals. Um, we practice debt free, so we're never going to say, no, don't pay off your mortgage. But it's not a conversation that we have some people who have mortgage rates that are like 2, 3%. I'm not going to push them to pay off their mortgage unless there's some other sort of reason that maybe they need to pay their mortgage off, just to because they want to retire. They're like, okay, I'm looking to retire here. I'm looking to cut back on work quickly, and we want to pay it off. And so I don't you don't have to worry about that bill. It's really figuring out like what that cash flow is. If it makes more sense for them, we always encourage people to go into retirement mortgage free, completely debt free. But it's not a conversation I'm going to have with somebody that's in their 30s and say, well, you need to pay your mortgage off really fast. Unless they have some sort of life goal that says, yep, let's pay that off, because that frees up a ton of wiggle room for you. So when you do decide to cut back on work here in the next 5 to 10 years, you're not having to worry about paying that mortgage payment too. If it's anything higher than 5%, we really say, hey, let's pay that off a little bit sooner rather than later for those
Mm.
mortgages, but it really is mortgage dependent. That's kind of the one where we're not like, oh my goodness, let's get that gone tomorrow. Unless
Yeah.
like, I recently saw somebody with a almost 8% mortgage. It was like 7 point something. That was like, let's pay that off sooner rather than later. So
Why is
it
there such a
varies
disparity between,
on
so you
the
said 2 and 3? two and three, and then seven and eight. Is this because of like prime credit, subprime, fixed versus floating?
It really is time when they got their mortgage. So some of these clients who have that 2, 3%, and they got it in like 2019, 2020, when COVID was happening and all of these things, interest rates were really low. And then interest rates skyrocketed. And now, like the 7% one, I want to say that they just received or just got that mortgage a year ago, maybe year and a half ago. I can't remember the exact timeline, but it was quite recently. So the rates were much higher in the United States, at least. I don't know what the impacts were in Australia, but in the United States, during COVID, interest rates really got incredibly low for the longest time. And they were pretty low for a year or two. And then they quickly skyrocketed and just went whoop, like real high. High for these times, people will say, well, it wasn't as high as the 80s. Yeah, that's true. But we're not talking about the 80s. We're talking about within the past like 10 years, they got real high. And it's just such a timing thing here and like everything that's been happening. They are coming down
Mm.
now a little bit lower. But they're still not what they were in 2020 timeframe, 2021, when their interest rates were substantially lower. So it's just when they got their
I mean,
mortgage.
we're coming to 2025.
Mm-hmm.
Do they still have a 2 or 3 year fixed rate because they opted in for a fixed rate for a long period of time? Is that why?
Yeah, absolutely. Fixed rate.
Okay.
We don't
For how
encourage
long?
variable rate mortgages, but yeah, they're like 15, 20, 30 year. Most of them are 30 years that I've seen though, because that's what most people tend to go for.
Yeah, that's amazing. So that's the reason why that I guess it's totally different in Australia is that we don't have fixed rates that go beyond 5 years. That's the max.
Oh, wow. Okay. I didn't know that.
So the majority of people have variable rates because fixed are not, you can't carry them that long. So
Mhm,
we had a lot of people come off fixed this year and last year, and there's probably going to be still some more next year
mhm,
that were able to fix rates at like 2.5, 3%, and they called it a mortgage cliff and sometimes a
mhm,
mortgage prison, where people were basically stuck with that bank because they weren't able to refinance once the loans come off of fixed. So they were going off of say two or three to like six, 6.5, and that's a massive jump. And that's why I was saying to you earlier about prioritizing paying this down or at least using an offset account, because it can be a massive cash flow strain if you
mhm,
haven't been able to amortize it or pay extra to the loan, because the debt levels are also higher, record highs as well. The median house
mhm,
price in Sydney, I believe, is around 1.5 million now. So for anyone living in the capital, if you want to buy a place to live in, you're spending over $1 million. And
mhm.
if you calculate $1 million repayment on 6% interest rate, I don't know what it is. I'm not a mathematician. I need to put in a calculator, but that's it's a significant amount, and for a
Yeah.
lot of people, that's unaffordable now. They might have been affordable at 3%, but it's not affordable at 6 and
Mhm.
above. So telling them to put money in an interest saving account at 5% doesn't make sense when they're paying
Yeah.
6% or more. So
Yeah.
I guess yeah, it's different markets. There is a long history as to why Australia doesn't have the long-term fixed rates. I don't know exactly. I can't tell you, but I do remember reading something about it, that it was due to a government change that we had,
Mhm,
and because of that change, we missed the boat on having access to that. So in
okay.
Australia, it really is around floating or variable rates, having offset accounts, and
Mhm,
refinancing regularly. So people switch banks every like
mhm.
2 years, really. They never stick around with that bank for 30 years, even though they have a 30-year loan term. They're
Yeah.
always looking for a better rate because those banks charge higher rates to existing clients versus new clients. So
Mhm.
they call that back book pricing and front book pricing. And
Yeah.
sometimes on the news and media, they call it the loyalty tax. So you're loyal
Mm.
to a bank and you actually end up paying more than a brand new customer. So
Yeah.
yeah, very different.
I mean, we have that with like that can happen sometimes with rents. Um, I we just renewed our lease and I went and looked and a unit just like ours. I'm like, man, we're spending more than a person if they were to sign up new. Um, but usually, like here in the United States, you can use that to get a lower rent rate. So, like, I've used that and said, hey, why are we paying more than a brand new person? And we've been here for a few years, and they'll work with you on that. So, it's not, I haven't heard of that. Like, it's not,
That
it's the
common.
same, but different, I guess. Yeah.
Yeah, yeah, we have that too. It's a customer retention.
Hmm.
So depending if you're a loyal client, but banks are smart in that they'll not just look at your conduct, how much you made your payments on time. They'll also look at your loan to value ratio, your LVR. So they'll say, what are you owing and what's the value?
Okay.
And
Yep.
realistically, and then because they know your income, they can probably do like an automatic serviceability assessment. This is my suspicion,
Mm,
where they'll be able to make a judgment call and say, all right, are you actually likely to get another loan to leave
mm.
and get a better rate, or are you trying to use that to get a better rate, even though you're kind of pretty much stuck? So
Yeah.
then they'll typically fight for the customer that is going to one have a real option to get a better deal and leave them, and two has a high level of lending where they're earning a good amount of interest in revenue. So if you're
Mhm.
borrowing, like if you got a loan of say 250,000 and you ask the bank, I've been loyal, can you give me a better interest rate? Highly unlikely they're going to reduce that. But if you owe like 2.5 million, they're going to fight to keep you on the books.
Yeah. No, that makes
So,
sense. That
mm.
I know that like happens with car loans here, but yeah, that makes total sense. So,
It's funny in
yeah.
here in Australia, car loans are the opposite.
Yeah.
You can't just go to a bank if you've got a car loan and say, "Give me a better rate." That
Oh,
you get a fixed rate for the entire term. You deal with it, right? And on top of
yeah.
that, if you try to get out of the car loan, there's usually penalties to pay it out early.
Oh,
So,
okay.
uh, yeah, so it's and banks don't like to refinance car loans because it's
Hmm.
a depreciating asset.
Yeah.
Whereas a house or a home usually increases in value. So they'll happily take that as collateral because it's reducing the risk over time. Whereas cars, the risk increases over time.
Yeah.
Yeah, yeah, it's
Yeah.
interesting. Um, so I guess a couple more questions before we finalize, we finalize the chat. Um, I wanted to ask a little bit around mindset. Do you help your clients to improve their mindset, like say from a
Mhm.
fixed mindset to a growth mindset, from scarcity sort of thought patterns to and beliefs to abundance? Is that something you guys work on?
Yeah, absolutely. We talk about that all the time. Even our clients who have, uh, you know, eight. I'm just like going through my head. 8 figures net worth. I almost said 10 figures. No, 8 figures. So like $10 million or more. They can still have we have we have some, and they're like, yeah, we're cutting our coupons and we're going. It's like, you don't need to do that. Yeah, they are like, that's not necessary at all. But if you want to do that, okay. um Sometimes we'll say, your assignment is to go buy a car, or hey, we want you to go spend this amount on travel or fun things every year. And so it really is encouraging them and kind of giving them a goal number to spend. And many times they don't
Mm,
hit the number because we try and make it a lot higher than we think they're going to actually hit, just because even if they get halfway there, they're doing more for themselves and more things that they enjoy than they probably have been in the past. It was so fun one day. We had a client and 6 figure travel goal. It was already 6 figures. We put it there, and they're like, we're not getting there. Like, okay, well, where are you gonna go? Like, you got to go someplace else. We always tell them, that we live vicariously through our clients sometimes, and so we'll say, wherever you go, send us pictures, and we'll say, we haven't gotten pictures recently. I think you need to go somewhere again. And so we encourage them to do them. And one day I finally got an email, and it said, hey, we're really enjoying the trip. It's been a lot of fun. We want to double our travel goal. I'm like, absolutely. You got it. I will increase that number for you all year long. And that's one of the things we do is we will often double their travel goals because they don't want to spend money on that. Or not necessarily they don't want to, but they don't feel like they can. But they so can. They've hit a point where they've done all the quote unquote good things for so many years that they can spend more on those things and have those experiences. And so we highly encourage them to go ahead and do that. But it really is it's a process. And they'll talk about it and like, man, I would have never done that, whether it's spending more, whether it's, hey, you're doing really well, you're making a solid income, but we just got to work on some fundamentals and kind of get some structures in place. The amount of people that I've seen come to us who don't even have a basic emergency fund in place, and they feel like they're strapped for cash or nervous or all these things because if something happens, what are they going to do? It's like, yeah, we just got to work on some fundamentals, but they've never really been taught it's okay to do those things. Um, and having those conversations and just encouraging them is incredibly fun to me. And it's really fun to say, hey, let's look at your net worth. We will often say, let's look at your historical net worth. So this is what it was when we started working together. This is what it is now. Here are the changes that you've made. And, you know, it's either staying the same, which is what we really want for a lot of our clients at a certain point, or we want it to go down, or hey, yeah, we had somebody who came back and said, I spent more money than I ever have this year. And we're like, yeah, okay. Yeah, like that to us does not bother us when they say that. It's okay. Did you have more fun than you ever had? Well, yeah, I think I did. Or somebody had never had flown first class before. They went and did their first class flight, and it was an older individual, and they're like, I want to do that all the time now. Like, I feel so much better. Just small changes like that they never would have worked and spent money on in the past that just make them feel better. And whether it's they enjoy it, they think it's fun, or physically, I'm a pretty tall person. I can tell you that I'm at the point in my life where I've just said I can't sit in an economy seat. I don't know if you've been in an economy seat, at least in the United States. My hips, like my hips are the back of that seat. My knees are in the other seat. Like I'm just too long for that. Um, so it's really those things like, hey, you don't need to sit through that if you don't want to. You're at a point where you don't have to do that. And just such
Yeah.
small changes that make big differences.
I love how like the conversation we're having is really talking about the other end of the spectrum, the people that have got plenty of money and yet they still don't spend enough for themselves.
Mhm. Yeah.
So they're technically financially free, they just don't feel financially free,
Hmm.
which is interesting. Um, because the other end, the normal end, when I say normal, I'd say the majority is working on your mindset so that you can earn more and
Hmm.
spend less so that you have more left over to do these things and actually travel and slowly increase your budget of traveling. And in your instance, they have the ability to increase their budget to travel. I mean, you said six figures, so that you're talking about what, $100,000 or more to travel the world. So, so yeah, it's interesting that doesn't matter where you are. It really is a mindset of feeling financially free and removing the anxiety that comes with money, earning money, and spending money, and having experiences without feeling like you're running out.
Hmm.
So, yeah, really interesting, and I'm curious, I guess, around, um, what are some of the, I guess, the key differences you would find in, say, a child-free couple or individual when they are traveling versus someone who's got a family and their and their children. What's the difference in the type of trips and the holidays they're looking out to experience?
Yeah, I don't have like a great outlook on, what it looks like for family travel. I can tell
Mhm.
you that many of our clients, though, have the option to just pick up and travel if they want to. And they'll say, I want to go somewhere this weekend. Cool. Go somewhere this weekend. And it's
Mm.
really, if they're working, they're obviously kind of confined a little bit by whether they have the time off or whether it's a holiday, anything like that. But it's okay, you want to go for, I don't know, 2, 3, 4 weeks somewhere. You want to go for a couple months somewhere? Great, let's do it. How can we make that happen? And we have a lot of clients who will go and just try out different places. We'll say, yeah, you want to go there for a couple months, get an Airbnb, stay in it. cool, great. So it's not a, I don't know that it's like all over the spectrum. I met with
Yeah.
somebody who said they were going to bike from, I don't remember where they were starting, somewhere up close to Canada, and wanted to end down in Central America. And we're like, okay, what do you need for a budget? I think $2 a day. In my mind, I'm like, how? $2 a day? You're gonna bike this entire way? Like, eh. So it's so different because that's something I wouldn't do. And that's one end of the spectrum. And then we have other clients who, just did this really amazing trip to South America, and they're like, yeah, it was $60,000. And I think it was $60,000 a person. And they're like, oh, I don't know that I can do that again. And it's kind of like, well, did you enjoy it? Did you have fun? Yeah, sure. Why not do it? So it's such a broad spectrum that it's very hard to
Yeah.
pinpoint that and say there's only one. There's only one because it's so different
Yeah.
with each client.
Well, I guess it comes down to what is actually financial freedom. And in your perspective, if I was to ask you right now, what does financial freedom mean to you? What's the answer that comes to mind?
Yeah. I would say it's having the ability to do the things that you enjoy, truly. And um, the ability to do the things you enjoy, but also I think the mindset that it's okay to do those
Mm.
things too, because you can have the ability, the actual financial ability to do the things you want, but not have the mindset of it's truly okay to go and do those things and have those experiences. So I think they go hand in hand, and often in the financial community, we only think that numbers are that the numbers are the only thing that matters when it's really not just the numbers. It's the numbers and the mindset.
Yeah, I definitely agree with that. And I think probably the part you said earlier about, whether you can take time off work. I think the other thing to me about financial freedom is actually having time freedom too.
Mhm.
Because if you, like my theory is that if you have enough recurring income from assets that replace your expenses to live and to fund the lifestyle that you want to have, so still traveling, maybe not the exorbitant traveling, but just a decent lifestyle that you currently live, but you don't need to work in order to get that income because your assets are generating it, so it's passive, right? As
Yep.
passive as it can be. Of course, it might be you have to be active at some level. It's not just going to do what it does without you putting some work in. But if that's coming from assets, then you don't work at that point because you have to work. You work because you want to work.
Hmm.
So then if you want to take a trip and go to South America or go for 2 months or whatever, there's nobody telling you you can or you can't. It's you.
Hmm.
You have that decision. And you don't have the responsibilities of needing to be at your desk or needing to turn up, 9 to 5 in order to sustain the life that you live from the income you're generating from work because you don't
Hmm.
need that money. So therefore, you're doing it voluntarily. To me, that's the goal, and that's how I want to help more and more people to get to that position. And it's why I invite guests like yourself onto the podcast to share your journey and some of the unique insights that you can share from the other side of the world. And I guess my last question is, if the listeners want to learn more about yourself, about Childfree Wealth, about what you guys do, and even if someone is in the US and they want to actually
Hmm.
potentially have a discovery session to see if you guys are the right fit, what's the best place that they can find you in, or best places?
Yeah, absolutely. So everything that we're on basically all the socials except for X, and it's just Child Free Wealth. You can go to our website, Child Free Wealth, and we have a podcast, also Child Free Wealth. So it's pretty easy to find us. Everything is Child Free Wealth, but you can go schedule a meeting on our website. It's probably a great way if you are not in the United States and you just want to hear more, listen to the podcast Child Free Wealth on all the podcast platforms and YouTube as well. So there are plenty of ways. Just put in the term Child Free Wealth and we will pop up and you can find us.
Yeah, amazing. And you mentioned that the founder is also releasing a book. Is that
Mhm.
is that out yet?
Yeah, so I guess the book will be out on December 30th. I can't remember if this is coming out before or after December 30th. So the book will be out on December 30th of 2024. And if you are listening to this prior to then, you pre-order the book, then you can email a copy of your receipt to media@childfreewealth.com. And we will put you into an entry for a drawing for a free Child Free Wealth checkup. Again, you do have to be in the United States for this. And then we also have some other fun little things, whether that be we might send you a first chapter of the book and just kind of get that out to you prior to release date so you can read that. There's also a Q&A that Dr. J will be doing as well. We've got some availability in there if you are one of the pre-orders and get your receipt emailed in, so you can join that Q&A group that's going on as well in January. So those are the things we've got.
Awesome. Well, thank you for sharing. I will get some of those and put them into the show notes, so any of the listeners that will have the direct links to access them. I just want to say thank you, Bri, for coming on the show. We appreciate your time and sharing your insights, and I hope it's for the listeners out there that this has been helpful. And now if you want to take it further, you know where you can reach Bri and the team. And for all the supporters of the podcast, I want to say thank you. If you can also check out our YouTube channel and our social media presence, we're also on everything except X. You can find us there. And for my business, Lagos Financial, you'll be able to go to the website, which is lagosfinancial.com.au, and go to the podcast tab. And this episode will be loaded very, very soon, as well as some other podcast episodes that I've been a guest on other people's shows as well. So thanks again. Enjoy, and I'll talk to all of you again soon. And Bri, cheers.
Thank you.